I'm Chris DeNunzio, a research analyst on the Global Listed Infrastructure team, and today I'm going to discuss our views on U.S. utility valuations, fundamentals, and outlook. Utilities are an important part of the listed infrastructure universe, and we see attractive value in the subsector today. U.S. utility stocks have underperformed the S&P 500 by 1,500 basis points year to date. Valuations are now extremely attractive, while utility financial outlooks are highly secure despite the pandemic. After the recent weakness, utility stocks now trade at a material 20% PE discount to the market. That spread is well above historical norms and does not reflect the current macroeconomic uncertainty driven by COVID-19, the persistent low interest rate environment, or improving fundamentals in the utility sector. Further, the discount may be even wider than appreciated if there is incremental downward pressure on S&P earnings. Utility EPS, on the other hand, is growing at a stable and consistent rate of 6% per annum on average. That growth is underpinned by investments in clean energy and grid modernization, and is generally being made within a predictable regulatory compact with allowed ROEs near 10%. The bottom line is that U.S. utility industry fundamentals are strong, while the macroeconomic and interest rate environment is constructive for defensive assets. Yet valuations are at historically compelling levels. We believe that U.S. utilities are attractive today and have simply been left behind in the recent recovery trade. I'm now going to break the conversation down into three component pieces. First, the impact that COVID-19 is having on the sector. Second, our views on clean energy growth. And third, our views on small cap utilities. With regards to COVID-19, the virus is only having a modest financial impact on the sector thus far. Power companies have been deemed essential services and have not seen a material disruption to their operations. In fact, lower commercial and industrial demand is being largely offset by an increase in residential load with more people working from home. State regulators have also moved quickly to protect the sector, with virtually every state allowing utilities to defer pandemic-related expenses and potentially recover them in future rate cases. The relative stability of utility earnings and cash flow is apparent when considering the fact that they have reduced financial guidance at the lowest rate of any S&P 500 sector since the outbreak of the virus. Separately, clean energy is providing substantial growth opportunities for the sector. Utilities are retiring legacy fossil fuel assets and replacing them with cost-effective renewables. This is a winning value proposition for customers, shareholders, regulators, and politicians. Long-term electrification trends and EVs should provide incremental sales and capital growth opportunities for years to come. We're in the early innings of a clean energy transition in this country. Finally, a particularly intriguing opportunity has emerged in small cap utility stocks. Small cap utilities have materially underperformed larger cap peers. This is a phenomenon that we've seen across the market, with small cap indices trailing the S&P. This makes sense in many sectors, where there may be relative benefits of size and scale in a recession. But the fundamentals in the utility sector are generally analogous regardless of size. There can be modest cost advantages or incremental growth opportunities associated with being a large utility, but that's not always the case, and the impact is often small. We therefore believe that some of the small cap weakness is technical in nature and simply reflects the fact that small cap indices have underperformed. This dislocation creates select opportunities amongst small cap utility stocks. In conclusion, U.S. utilities are often a defensive haven for investors during times of economic uncertainty. Yet utilities have underperformed the market and are undervalued relative to history today, despite a tremendous amount of economic uncertainty driven by the coronavirus pandemic. The low interest rate environment should also be constructive for higher yielding hard assets like utilities. Yet, on a dividend yield basis when compared to bonds, the sector is at its most attractive level in over 40 years. With strong, renewable-driven fundamentals and attractive valuations, we believe that U.S. utilities are compelling today. Thank you for your time, and we look forward to keeping you updated with our thoughts on the sector going forward.